In this chapter, we discuss how we measure domestic output. I actually defined GDP, which is the measurement of domestic output, in the previous chapter. I defined it as the value of all final goods and services produced in the economy in a year. Still rather vague, we'll talk about how we actually measure it and how we actually measure it in two different ways. Notice my subtitle is it's very big, because it is. The GDP of the United States is somewhere between 18 and 19 trillion dollars, and it on the average grows at about 3.1% per year over the long run. Recent growth has been much slower since the last recession. What is measured in GDP? Or I should say, what is not measured in GDP? Well, we have four things. These, I think, the first I mentioned before. Intermediate goods. These are goods that become part of a final good. For instance, if I build a car, I put tires on it and a battery in it. We don't count the tires and the batteries because the value of the final car is going to cover the portion that goes into GDP. So the intermediate goods are not really ignored, and in fact, quite the contrary. If we counted them twice, if we counted them and we counted the final product, we would count them twice. So we're trying to alleviate the problem of double counting. Non-productive transactions are also not included. Notice that the definition is production. Well, non-productive transactions are not included. For instance, just simply transfer of ownership of property, stock market transactions. These are non-productive transactions, and we do not include them in GDP. Same with financial transactions. The one I mentioned, the stock market transaction, would also be looked at as a financial transaction. A loan at the bank is a financial transaction not included in GDP. And then finally, secondhand sales. These are sales of products that have been made previously. They were counted at one point in GDP when they were originally produced and sold. They're not counted twice. Now, I might make a minor point on this. If you buy something used and then you buy something to repair it with, the cost of the repair is going to be included in the current GDP. You could look at older homes or pre-existing homes as being secondhand sales, as well as automobiles, used automobiles. Sometimes we buy these things and we make repairs to them, and the repairs will be included in GDP. We have two ways to measure GDP, and they turn out they should give us exactly the same number, although in a highly complex, large economy, sometimes we don't get it exact, and that's something we'll discuss a little bit later and how we adjust for that. But we have two ways to measure it. One is expenditure and one is income. If you think about the circular flow that we discussed earlier in the course, the expenditure of business to, say, employees was an income to the employee. So whatever they expended was income to someone. That's also important because what it says is everything the business spends or expends becomes income to someone, and then if consumers spend, it becomes an income to the business. So it's important that understand these. Now, we will create both an expenditure formula and show you an income formula, but most of our emphasis throughout the rest of the course is going to be using the expenditure formula. So what are included in expenditures? Well, think about the definition of GDP. It said it's the value of all final goods and services produced in the economy in a year. So if you look at the four sectors of the economy that we've discussed, households, businesses, government, and the foreign sector, what is it that they purchase that is in its final form? Well, when it comes to consumption, i.e. households spending, it's pretty much everything. Anything we buy as a household is a final good or service. Most of us are spending it, buying those items so that we can use them in our household. Now note, if you're saving money and then using that money to invest, say, in rental property or a business, that's not consumption. That's going to be investment. So keep that in mind, that part is not really consumption. The other thing that business does, and the only thing that business does, because if you think about it, we would think, well, is the only thing business does is take materials and create other products out of them. So everything they buy is an intermediate good, correct? Not quite. They need some final goods and services to actually produce those. For instance, they have to produce them in buildings, they have machinery and equipment, and they have to have inventory. And so those items are included in gross private domestic investment, and I'll discuss each of those individually here. Buildings are considered investment, and it really doesn't make any difference what kind of building I'm building, it's still considered an investment. We, of course, can easily accept that if John Deere builds a large building for manufacturing, that is investment. Even a small company, a grocery store, that building would be an investment good. On the other hand, the one item that is a little confusing, I think, to most students is the idea that new homes are considered investment. The reason they're considered investment, or at least the explanation goes, is they provide a stream of housing services. So we don't treat purchase of homes as consumption, we treat them as an investment. They're long-term, providing housing services. Second in this category is machinery and equipment. This is pretty obvious. We buy machines, we buy equipment, that's used as an investment good to produce something. For instance, I'm a farmer, I buy a tractor, that is an investment good because what I'm now going to produce and sell is whatever I grow in my field, soybeans, corn, etc. If I make binderies for publishers, that type of machinery would have to be purchased, and so would the equipment needed to build that. So that is considered a final good or service consumed by companies. Third is inventory. Now, inventory is kind of interesting. You don't imagine inventory as being an investment, but in fact it is. Because you say, well, don't we just buy products and then resell them, like Walmart gets product in and then it sells it? And it's like, yes, it does, but it always has to have a minimal level of inventory in order to have sales. So inventory turns out to be an investment good too. We are investing in an inventory in hopes that we are going to actually sell it. Obviously, if we don't, we're either going to have to discount it, and those are some adjustments that come into the fine details of calculating GDP that we're not going to get into in this course. Finally, we have really three types of investment, although all related. What we've defined here is something called gross private domestic investment, and let me go through each of those words. Gross means all, private means in the private sector, domestic means in the United States, and of course we now know investment is a purchase of either buildings, machinery, equipment, or inventory, basically purchase of capital goods. Out of that gross investment, some of that investment will be used to replace existing investment. Maybe inventory is the easiest one to see because, for instance, if I sell inventory and I buy inventory, some of that inventory is replacing the inventory I've sold. So that's replacement investment. Then the question becomes is, what if I buy more than enough to replace my existing investment or capital? And that is net investment. And that can be either positive or negative. So net investment is gross investment minus replacement investment. That gives us net investment. If replacement investment is larger than gross investment, then we obviously have negative net investment. And we have seen that rarely in U.S. history for the economy. It did happen in the 1930s in the Great Depression, but I do not believe I've found any statistics to support that it's ever happened since. It can come very close. For instance, if you could, for instance, in the area of inventory, you could sell all your inventory and then buy less than you had before. That would make inventory decline, which would be a form of negative net investment. That's probably not going to last long either. The other two are easily defined, but we need to understand, at least in the case of government consumption, what it really means. Notice the term government consumption. Let me give you a slightly different explanation of that. Government consumption is the government's purchasing of goods and services. Those can be people hired, they can be, the Defense Department buying airplanes, et cetera, et cetera. That is government consumption. It is not government spending, because government spending also includes something called transfer payments, and these are not included in expenditure in government consumption. Why? Because the government is not buying anything. In fact, transfer payments are defined as a payment by government for which it gets nothing in return. You could call this a welfare payment. I don't like to use that term because it tends to make it too narrow in most people's minds, but it's a form of a subsidy. When we give farmers money for not growing crops, which we have in the past, that's a form of a transfer payment. If we subsidize large corporations, then that's a transfer payment. If we give people money, food stamps turn out to be transfer payments. And the last one, and one that will get you in an argument any place, is Social Security. Social Security is a transfer payment. And the reason it is because what we're paying in today is paying today's recipients. And people argue, but I have a trust fund there. And the reality is, no, you have no trust fund there. You are simply spending money that they are giving you from other people's paychecks currently. In fact, if you look at the term transfer payment, it means we're transferring money from one individual to another, plain and simple. If you add government consumption and transfer payments, that's going to give you the total of government expenditures. And then finally, net exports, which I have labeled X, are very simple. That is what we spend on exports minus it is what is spent on exports, in other words, products that we sell to other countries, minus what we spend on imports. So export payments coming from other countries to us for goods and services we sell them, are then we take that number and we subtract imports, which is money that we pay out to other countries for products they have sold us. Because it is the difference between exports and imports, it can be either negative or positive. As we'll see in just a second, if that number is negative, then it actually detracts from GDP. While I'm saying that is just a mathematical statement and does not really connote anything else other than that. And we have been running negative net exports for some times. So, what is the expenditure formula? Well, we add these four components together: consumption, gross private domestic investment, government consumption, and net exports, and that is our expenditure formula for GDP. And for the remaining weeks of the course, you will see that every night. Why? Because what we're really trying to do is influence GDP. Because if GDP goes up, we hire more people, we use more resources, incomes rise, and that's the idea. And so as I point out, we're going to use this throughout the rest of the course. So you should get very tired of it, but the other thing is you should know it very, very well. The one thing I would make a point of, GDP is important in the gross sense, but probably a better measure of the standard of living in a country is GDP per capita or per person. Now, national income also measures GDP. If you think back to the circular flow, as I explained, we pointed out that expenditures by one group have to equal income by another group. So if we pay money out to businesses, they receive it. That is their income. If they pay money out to us, that's their expenditure and that's our income. And again, that's shown in the circular flow. And there are 5 components to national income. 4 of them are payments for resources. You remember had four basic resources: land, labor, capital, and entrepreneurial ability. Well, land received rent. That's one of the payments to a resource. That's included. Labor received wages. Now, we're going to change that slightly. We do still include wages, but what we really mean here by wages is everything that is paid in the name of that employee. So everything that's paid in the name of employee is the combination of the wages they receive plus any benefits they may have. So that is total compensation. So what we're really talking about when we talk about labor is compensation to labor. So the other one is capital, and capital receive payments in the form of interest or dividends, and we don't really distinguish between those very much. So now we have land, we have labor, we have capital, and then finally we have entrepreneurial ability, and the entrepreneur receives profits. And those profits, by the way, are a cost. Some people have argued incorrectly they are not. Profits are just a surplus. They're not a surplus. They're a payment to the entrepreneur for taking all the resources and putting them together to create another product or service. So that is being paid for his creativity and innovation and work. One payment that is made to government is earned by the factors of production but not received by them, since it is taxed away, and that's indirect business taxes. So what do we have here? Well, national income is the sum of wages and other compensation paid to labor, rent, it's actually net rent, paid for the use of land, interest is interest and really dividends that are paid for the use of capital, profits, and you note we break profits down into two categories, and this is just really a legal distinction here. We break them into corporate profits and proprietor's income. So we're really talking about the two major legal forms of business: corporate profits, proprietor's income. And if you're going to ask me about partnerships, that's really proprietor's income. So those two are treated separately, mainly because of the way that they report to taxes. What we call a profit in a corporation is a little bit different than a profit in a sole proprietorship. In fact, profit in a sole proprietorship is the proprietor's income. Profit in a corporation is not considered necessarily what it really is money that can be used either for retained earnings or for dividends. And then finally we have the indirect business taxes, which we have mentioned. Those are things like sales taxes. So if we look at the two, there are three other items that must be added to national income to get GDP. Again, we have a complicated situation here. The first thing we add in is net foreign factor income. Many years ago, we changed from gross national product to gross domestic product because we were ignoring this net foreign factor income. In other words, if I'm an American working for a foreign country and I'm living in the United States, and even if I'm not living in the United States, that is a payment to an American for something they are doing. So that is a foreign factor income. And what we include here is the net, which is what they pay to American citizens for services rendered versus what we pay to foreigners for services rendered, and we net those out. That actually is a fairly small number, but it does make some difference. Second is consumption of fixed capital, known as the capital consumption allowance. And this is basically, you'd call it depreciation, replacement, investment, et cetera, et cetera. Last is statistical discrepancy. That simply means we couldn't get the books to balance, so we threw in a number to make them balance. Why? Because when you add up all these numbers, they're simply going to be, at an $18 trillion level, is just not going to quite balance. Thus, GDP is equal to national income plus net foreign factor income plus capital consumption allowance plus statistical discrepancy. Now, we've talked about GDP, and early on we talked about the distinction between nominal and real GDP. And effectively what nominal GDP is, it is current output measured at current prices. So in year 2000, I would take whatever we produced in year 2000 times what was charged for prices in 2000 for those goods or services. In 2007, I would take what is produced and multiply that by whatever prices were in 2007. And so that becomes the nominal GDP. And as you can see, it's simply P times Q. Thus, GDP can rise if either price or output rises. The problem is price increases don't do anything. So what we really want to do is get some measure of Q and wring out all those price increases. So price increases are called inflation, and they tell us nothing about output changes. So what we want is a measure that keeps prices constant and shows just increases in output. This is called real GDP. So real GDP keeps prices constant using what we call a base year, and then allows the quantity of output to change. So what we're doing, for instance, is if we use the year 2000 as our base year, we are assuming all prices are the same as they were in the year 2000. So what we do is we have to adjust nominal GDP using a price index. It's how we really do it. We don't actually go back and do it quite the way I've explained, but we use a price index. A price index chooses a basket of goods or a group of goods, often called a market basket of goods, and then compares the price of this basket of goods to the price of goods in a year we choose as the base year. So for instance, we've said 2000 is our base year. So assume we've chosen the year 2000 as base year, and we have a basket of goods we have chosen to use, and it costs $1,400 in the year 2000. Assume in 2001 the same goods cost $1,500. We would create an index value using the following formula. Price in the given year, that's the one we're measuring, the 2001 year, divided by prices and the price of the goods in the base year, that's the year 2000, and then we'll multiply that by 100. What that really gives us when we do that is really gives us a percentage without a percent sign. So what you're saying in this case is prices in 2001 are 107% of what they were in the year 2000. Now, if they were lower, that index number would be less than 1. So these numbers do get smaller. So for instance, we went back to 1999, we would probably have an index value less than 100. And the index values now is what we're going to use. So that becomes important to understanding it. So we were going to adjust each year. Now, a couple of points. Is there any mystery to the base year? And the answer is no. They can choose any year they want. The second is, if you look at the actual data, it's not quite what they will probably give you. For instance, right now we tend to be using 1982-84 as the base year. You might say, well, that's not really a year. That's like 3 years, 82, 83, 84. And so that's what they do. But they also do one other thing, and this is what has been a complaint about the way we measure inflation anyway. And that is they also try to take into account how people adjust their consumption. For instance, the price of good goes up, we would say, well, if the price of one good goes up, people substitute to another good, right? It's going to be a little cheaper. Well, again, what they try to do is take that into account. And it's not perfect science, but it tries to get at the idea that people are making changes when relative prices change. So it's a little more sophisticated than I've shown, but it still is the same basic idea. What are some of the shortcomings of GDP? Well, non-market activities are not included. This is kind of a problem in especially underdeveloped nations. That's why it's so hard to measure GDP in those nations, and it may be misleading. For instance, when the United States was heavily agricultural and most of the population was involved in agriculture, there were a lot of non-market activities that took place. People would barter for goods and services, sell their product or exchange their product, and no money would ever change hands, and therefore it would never get included. So if it's not really a market activity, then it does not get included. So in theory, if you barter for something based on IRS rules, you're supposed to report it, but the reality is they probably don't. People simply say, I'll trade this for that, and they forget about it. Leisure is not accounted for, not directly at least. In other words, we don't know how much time it's taking to make this GDP. So if we can make the same amount of GDP with fewer hours of work, that gives us more leisure time. And that really is, there's no way we can really account for that in GDP. The only comment I often make about that is when we have leisure time, we often go out and spend money and probably increase the GDP. So, maybe indirectly it is, but directly it's not. It does not take into account improved quality. That's not measured. And I'd also point out, it also does not take into account poor quality. And I've watched markets long enough to know that at periods of time we have seen products not only not improve, we've seen them actually get worse. Usually, a lot of times during high inflation periods, companies will begin to kind of skimp on resources, try to keep prices down, and they actually end up making a not so good product. There apparently is a committee that tries to adjust for this, but it's a very inexact science. For instance, I would tell you that the car you buy today is not the same car as you would have bought 40 years ago. They're much better, they last longer, they don't take as much maintenance. And in fact, the fact that they don't take as much maintenance actually reduces GDP. So the better quality car is actually in some ways reducing GDP. We also don't take into account the underground economy. These are simply exchanges that are not reported. This is not necessarily an illegal activity. It is simply what we call part of the underground economy. So if somebody comes along and says, hey, I'll remove your snow for $20 off your sidewalk, you pay him, it's highly unlikely that money is getting reported to the government at all. That's part of the underground economy. We know it's large. We don't know how large. There have been some estimates made. The major point I would make there, as long as it remains about the same percentage of GDP, while it may cause us to undercount GDP, as long as it's consistent, we're still getting a pretty good measure. Environmental issues are also not included in GDP, at least not directly, and this point's often been made. If a company pollutes a site, you would look at that really as a negative. But surprisingly, what happens is we come in and we clean up the pollution, which wasn't there in the first place. That cleanup is going to be part of GDP. So people have often argued that that should actually be a detraction from GDP, the fact that we have environmental damage. I really don't have a strong opinion on that. There's some people who have tried to measure it, and of course it's going to tend to reduce your GDP. It also doesn't tell us anything about the distribution of income. Countries with a certain amount of GDP may be skewed to a very small percentage of people. This has become a big issue in the United States, the distribution of income, and actually in many countries. But I would suggest that probably poorer countries with lower GDPs have much worse distributions of income than the United States. Actually, growing GDP actually tends to make distribution better. And maybe the fact that GDP is not growing as fast as it has in the past may be causing some of that maldistribution. I could talk about other things, but not really part of the course. And they also don't talk about non-economic sources of well-being. What do we mean by that? Well, if we feel more secure, if we feel healthier, that doesn't get taken into account. You might say, well, isn't that due to having bigger police departments and having better health care, and isn't that, yeah, that is, but it's not necessarily so. It can simply come out of an optimistic perspective on the economy, which has absolutely nothing to do with anything that's been done. For instance, we build highways. That gets included in GDP. But the fact that I feel better and feel that I can commute faster and feel safer being able to get to a hospital doesn't get taken into account at all. Or the fact we created 911 and it made people feel safer. 911 actually probably added almost nothing to GDP after the initial creation of the system. So those